Welcome back. We are less than 2 weeks away, of course, from 2025. Our next guest says that markets continue to support sectors and themes that benefit from or provide a hedge against inflation, like materials, for instance. Joining us with some stop picks and his market views is David Burrows, President and Chief Investment Strategist at Barometer Capital Management. What do you mean by that, first of all, that the market will support sectors and themes that benefit from a hedge against inflation?
When you look at really what's been working in markets throughout the year, I mean, beyond mega cap tech, it's been sectors that have the ability to put price up tomorrow if costs go up today.
Okay.
If you look at the things that would tend to do well in a disinflationary world, things that act like bonds, they've been performing poorly and far worse than the market through the course of the year. This year, when the Fed cut rates in September, it was the first year in 40 years where the yield on a long-term Treasury bond went up. And they've been going up ever since. So we're going to wind up with another cut today. And the bond market would tell you that bond investors are building in an expectation of more risk premium for being, or term premium for having a longer term commitment. That says to me that they are expecting inflation to stay elevated. Now, if you look at the inflation data over the last 6 or 8 weeks, globally, in general, it's coming in a little warmer than expected. That sort of pullback in inflation appears to have stalled. And that would fit with what tends to happen after a first inflationary wave. You correct, and then you wind up with a second inflationary wave. So until those defensive sectors start to behave better, it tells you that the risk is that inflation is a little bit warmer, and so we need to own things that protect us against that and protect our purchasing power.
And that includes the financials, which I believe is your largest sector weighting in the equity markets,
yeah,
correct?
All year long, it's been 25 to 30% of our holdings. It's about 30% today, and that includes banks, it includes regional banks, it includes insurance companies. They, of course, benefit when short rates are lower and longer-term rates are higher, and they can capture a spread. And they certainly benefit from inflation.
JP Morgan is one of your holdings in the United States.
Yeah, so our big belief is when we're going to buy a sector, we want to own the very best. And I've highlighted before, but you know, the XLF, or the financial sector in the U.S., made a high in 2007, didn't make another high till 2021, yet JP Morgan made a new high in 2013. So they really have been winning everywhere. But in particular, when we're trying to protect against inflation, we want a rising stream of dividends. Rising stream of dividends offset a rising cost of living. JP Morgan's raised their dividend twice this year and will likely continue to do that because capital markets continue to be quite strong and they're doing well across their business.
And you like Canadian financials as well. A couple of picks that we just saw there are big names in the Canadian financials. Why don't we begin with CIBC? Does that fit your theme of owning the best of the sector?
It does. I mean, the two biggest holdings we have in the banks, and both, one is in our top 10, CIBC is our second biggest holding. You know, they do very well in the Canadian domestic economy. They've sort of stuck to their knitting. They've done a good job in all of their business lines. But again, this is one that we think we're going to see dividend growth in. We've seen financials pull back a little bit, about half of what was gained in November. Yet CIBC is holding right near the highs, and Royal is as well.
Do you own Royal?
We own Royal.
Right.
Royal and CIBC would be our two big holdings. We also own some National Bank. But then the insurance companies also benefit in this world. So Fairfax would be our largest holding across the firm and has been through the course of the year. But the property and casualty companies have been able to raise their premiums. And given some of the catastrophes this year, that likely continue to happen next year. And then with higher interest rates, they benefit in their bond portfolios.
When Fairfax releases quarterly results, what numbers do you look at most closely?
So, of course, you look at you know, what they're paying out versus what they're generating in their investment portfolio. And really, you're buying a large size investment portfolio and their ability to outstrip the costs that they have to pay out. And so they've just done a wonderful job with their investments and their ability to raise premiums.
Let's switch to Netflix, another stock you like. Does this fit the definition of a company able to raise prices if costs go up?
Yeah, you know, look, first of all, when rates are going higher, you want to own companies that generate cash. that don't need a lot of financing, right? So that the cost of financing doesn't hurt them. And of course, Netflix is a big cash generating business now. When they want, and they seem to be able to do it at will, you add $1 to the monthly subscription cost. We're big investors outside of public markets in music royalties. Similarly, when Spotify wants from time to time, they put their price up by $1, so we get a steady income stream, but it's a rising income stream. And so we like those types of things in an inflationary world.
David, we'll have to leave it there, but thank you so much for coming in.
Thanks for having me, Paul.
David Burrows is President and Chief Investment Strategist at Barometer Capital Management. Those are his thoughts on the market and several stocks he's holding. His colleagues and he are holding on behalf of clients at Barometer. Yes.